Let's welcome in our first guest on the show. Aniruddha is now with us. Aniruddha, what's your perspective on the markets? How would you essentially look at Nifty at 18,000 versus S&P being at 3,900?
So thank you for having me over. So we've generally been positive in the markets. Over the longer term, we definitely believe India is going to be a place where money will flow in. It has the right fundamentals in place, especially given the perspective when we look at it vis-a-vis where the world is. In the near term, yes, 18,000 Nifty levels, whether it is 18,000 or higher, I think from a valuations perspective, we are a little at a premium to the overall long-term averages that the index has usually traded at. To that extent, in the near term, can we go through some amount of time correction? That could happen. But over the next 3-5 years, we remain extremely positive on how India will pan out in terms of the overall fundamentals, the economy, and the markets will probably follow suit.
How would you look at the FII flows? You know, in this entire rally, they have been one of the sellers. How would you look at that versus when they come back to buy?
Yeah, our sense is FII is generally in the markets, they used to be almost 24-25% of the overall market the equity holdings. It's come down to about 16-17% today. From that perspective, the significance of FII flows have for the overall market performance has definitely come off. Our sense, again, when you look at whenever interest rates start pivoting the other way around, the risk appetite will definitely come back into the markets. When the risk appetite comes back, people will start looking at emerging markets. Today, when you look at the emerging markets, there are quite a few markets which are uninvestable, given the geopolitical risks that are going across. And India will definitely stand out in that sphere. Now, it's very difficult to take a call, but sometime during the next calendar year, you are going to see that risk appetite coming back and FIIs coming back to buy. And we remain, it will become a very interesting market at that point of time because you will have the fundamentals backing this market along with FIIs flows coming back. So we remain positive on how FIIs will probably behave in the next calendar year. In the interim, we are not really bothered about how, if the FIIs continue to take out money. I think the retail level investors within India have matured. They realize that with a longer term perspective, this is the place where you will go ahead and, build a lot of wealth. And every dip is an opportunity to get invested in.
What do you make of the numbers? You know, banking numbers have looked strong, consumer company numbers have looked okay. How would you essentially look at the entire results so far?
So, see, from the results perspective, I think so. There are two segments which we clearly break it up into. One is the commodity and energy basket, and the other is the rest of the markets. Now, commodity and energy would probably not keep up to the numbers that it had delivered in the first 2 quarters of this financial year, simply because things have come off in terms of how commodity prices are behaving and energy prices are behaving. The third segment where probably there would be some amount of a little bit of a disappointment at least going ahead probably could be IT. But vis-a-vis that, when you look at sectors which are domestic oriented, something as you mentioned, BFSI, consumers, industrials, auto and auto ancillary, we believe this segment, this set of companies will go ahead and deliver good numbers. We remain positive on these segments. I think anything which is domestic oriented or domestic centric in terms of serving the Indian market should do reasonably well in the next 2 quarters. And probably if things continue, it will probably be a longer term structural story to play domestic sectors in India vis-a-vis probably playing either the cyclicals or the exports.
Where do you keep this new age companies? You know, we've seen large new age companies where there was a lot of excitement around the listing, finally starting to see a correction as far as their valuation are concerned. You know, a proper event of de-rating. Would you be looking to buy into these names now?
So we've actually stayed away from all of them. Our model, the way we look at businesses, we look out for businesses which have got strong operating cash flows, clean balance sheets. Now, and of course, at some point, profitability. Now, when I look at these businesses, the opportunities are definitely large in terms of how big they can be. But from a fundamental perspective, when we look at these businesses, one is the cash flows are not there. The OCF generation is probably negative in most of them. FCF is a far thought out process. I don't know when it's going to happen. The balance sheets are not very strong. Of course, they have got capital infused from the private equity sides, which stops now. So we'll have to see how they fund their growth. And from a valuations perspective, they are not cheap even now. That is the way we look at it. So we haven't participated in any of them. Would we look at them? Probably at some point, yes, because the opportunity or the runway is long and pretty big. But from in the near term, I mean, we would want, especially given the fact that, interest rates are moving higher, the cost of capital becomes that much more costlier for these companies. Till the point they are not able to fund their future growth through internal accruals, we will probably skip this set of companies.
So what to buy in this market? We've seen a lot of pharma companies talking about pricing concerns. Banks have done well and they have delivered well. Auto numbers have looked strong and still, stocks have also rallied. So how should one, look into this market, where there is opportunity in the market, where there is a pricing mismatch?
Sure. So our belief is financials have done well, but when you look at financials over the last 3-5 years, I mean, they are just coming back to probably some amount of, there's still a lot of valuation comfort there. Credit growth is strong. They are well capitalized and asset quality has ebbed off, the issues of asset quality. So from that perspective, we remain positive on financials. And to that extent, where asset quality and capitalization is no more a concern, even the public sector banks look good today with a 18 to 24 month perspective. So that is one segment where we will clearly look out for. If there are corrections, we will clearly look out to build positions into that segment. The second segment where we believe as a sector which has faced a lot of challenge in the last 3-4 years, but the runway looks good for, is auto and auto ancillary. This is a sector, in the last 3 years, it's gone through a shift from BS3 to BS4, BS4 to BS6. COVID hit them. Diesel, then crude oil prices moving from say $40 to $140, that hit them. Semiconductor availability was an issue. So the last 3-4 years were very challenging for this sector. Clearly, we believe the next 3-4 years, the amount of challenge for this sector will be far easier in that sense, vis-a-vis what they have faced. And hence, this is another sector that we like. From a little longer term perspective, over the next 3-5 years, we clearly believe India is at the cusp of a capex cycle to that extent. Clearly, capacity utilizations are reasonably high, balance sheets are clean, and hence from that perspective, we are seeing sporadic but definitely measured capex coming through from corporate India. This will also be supported by the capex activity which the government is doing. So to that extent, industrials again is another segment where we remain positive. Lastly, though valuations might be a little stretched from a longer term perspective, I think discretionary consumption in India is well placed. So into a correction, this is another segment that we will look at. If you think of all the 4 segments, these are more India centric, and we believe these are segments which will prove resilient in case of a market correction.
In terms of capex, you said it's an interesting one. How should one play it? Should one look at pure play, cap goods play? But there are a lot of other single product, single sector catering companies as well in the ancillary capex space. You can also look at that.
So thank you. This is an interesting question. Actually, our belief is we would look at the full value chain, whether to play it through industrial goods, whether to play it through infra plays, whether to play it through cement to that extent, which participates in capex or the infrastructure activity. We generally prefer to play it through industrials and capital goods because these companies, they've got very clean balance sheets, reasonably strong cash flows, and they don't dilute equity. Invariably, what we have seen historically is into a capex cycle, infra companies invariably go ahead and dilute, and that actually doesn't result into a reasonably strong EPS growth because the EPS gets diluted. So our belief is the best proxy to play industrials and infrastructure, a capex cycle, is to either play it through industrials or to play it through cement, where dilution has been very minimal.
So thank you so much, sir, for taking out time for us. Always good to get perspective from you. On that note, we're taking a break, going into